Breaking IRS news story. In today's video, we are going to go over foreign bank accounts and why you need to make sure you are reporting them to the Internal Revenue Service. Welcome back, everyone. So very happy to have you back for another IRS update. Now, a federal criminal complaint charged a Florida man with conspiring to defraud the United States by hiding income and assets offshore and with making a false statement to the IRS. According to the allegations contained in the complaint, between 1985 and 2020, Dan Rota hid more than $20 million in assets in at least 24 secret bank accounts at 5 different Swiss banks, including the UBS and Credit Suisse. Over the years, Rota allegedly earned substantial income from these assets that he did not report on his tax returns. Starting in 2008, after it was reported publicly that UBS and its bankers were under criminal investigation for helping U.S. taxpayers evade paying taxes, Rota allegedly took steps to continue concealing his offshore assets, including by closing his UBS account and moving the funds to Credit Suisse and another Swiss bank, then later transferring the funds into Swiss bank accounts in the name of nominees. He did all of that and the IRS still got him. In 2011, the IRS allegedly began auditing Rota after it obtained evidence that he had unreported foreign financial accounts. Allegedly, Rota falsely denied that he had any such accounts during the audit. The IRS allegedly obtained evidence showing Rota received transfers of hundreds of thousands of dollars from these foreign accounts that he did not report on his tax returns. Rota allegedly claimed that these transfers were non-taxable loans from third parties and caused his representatives to present the IRS with this sham loan document to corroborate his claims. Now, as part of the scheme, Rota allegedly enlisted his friends and cousin, co-conspirator one, a native and resident of Brazil, to claim to the IRS that he either made or facilitated the fake loans. The IRS allegedly did not believe Rota and then assessed additional taxes as well as penalties and interest against him. Rota allegedly then caused a petition in the U.S. tax court to be filed that sought a redetermination of the IRS assessments. In that petition, Rota, through his attorney, allegedly falsely denied having any foreign accounts and attached the fictitious loan document. Furthermore, Rota allegedly caused co-conspirator one to travel to the United States and retell the false loan story to the IRS attorneys. He was persistent in continuing this lie. In 2017, after Rota allegedly presented evidence showing that the perpetrated loans had been repaid, the IRS reversed the deficiencies and agreed that Rota owed no additional taxes. Now, unbeknownst to the IRS, however, the funds that Rota repaid to the third parties allegedly went into accounts that he controlled. In 2019, after he allegedly became aware that the IRS would receive copies of his Swiss bank accounts, Rota attempted to participate in the IRS voluntarily disclosure practice. Now he wanted to come clean. Under that practice, taxpayers who willfully do not comply with their tax and reporting obligations can make timely, accurate, and complete disclosures of their conduct, which may be a way to resolve their non-compliance and limit the criminal exposure. In his submission, which was signed under penalties of perjury, Arata allegedly made several false statements again. He was then arrested on March 9th and made his initial court appearance before the U.S. magistrate judge. Now, if convicted, Arata faces a maximum penalty of 5 years in prison for the conspiracy charge and 5 years in prison for the false statement charge. A federal district court judge will determine any sentence after considering the U.S. sentencing guidelines and other statutory factors. The International Tax and Financial Group of IRS Criminal Investigation is the one who investigated this particular case. You can find this breaking IRS news story on the Office of Public Affairs, U.S. Department of Justice website. Now, let's move on to the Internal Revenue Service website. Report of Foreign Bank and Financial Accounts, FBAR. Now, per the Bank Secrecy Act, every year you must report certain foreign financial accounts, such as bank accounts, brokerage accounts, and mutual funds to the Treasury Department and keep certain records of those accounts. You report the accounts by filing a report of foreign bank and financial accounts called FBAR on Financial Crimes Information Network, that is FINCEN Form 114. Now, who must file this FBAR? A U.S. person, including a citizen, resident, corporation, partnership, limited liability company, trust, and estate, all must file the FBAR report. A financial interest in or signature or other authority over at least one financial account located outside the United States if the aggregated value of those foreign financial accounts exceeds $10,000 at any time during the calendar year. Generally, an account at a financial institution located outside the United States is a foreign financial account. Whether the account produced taxable income has no effect on whether the account is a foreign financial account for FBAR purposes. You do not need to file an FBAR report if all your foreign financial accounts are reported on a consolidated FBAR, or you jointly own all your foreign financial accounts with your spouse and you completed and signed the FINCEN Form 11A authorizing your spouse to file on your behalf, and your spouse reports the jointly owned accounts on a timely file signed FBAR. Income tax filing status, such as married filing jointly and married filing separately, has no effect on your qualification for this exemption to file the FBAR report. Please share your comments on this breaking IRS news stories. What are your thoughts, as well as what are your thoughts on this FBAR policy of reporting all foreign accounts? And don't forget to like, comment, share, subscribe, hit that notification bell, and come back for more 2024 tax season updates and breaking news. Bye-bye.